Today we'll cover about the basics of the option. So the million-dollar question is, uh, so today's agenda will be what what is an option, what is the risk and reward profile of the option, what is the moneyness of the option, and what is the option Greeks. There are essentially five Greeks: delta, gamma, vega, theta, and rho. We'll learn about that. Then it will be followed by a Q&A round. Anybody who has any question in between the session, he can hold it for a while and just note it down, and we will try to solve your query at the end of the session in the Q&A round. So, what is an option? Options are financial derivative contract that give buyers or a holder the right but not the obligation to buy or sell an underlying asset at an agreed upon price and at an agreed upon date. So, in this definition, this is a very bookish definition. Let me just break it down for you. Right, but not the obligation. This is the definition that we are reading from the point of view of option buyers. And another thing is that from here onwards, if I'll just want to mean an option buyer, I'll just say holder of the option. And if I'll mean the option seller, then I'll just say writer of the option. Because if I'll say buy or sell, then it will create a lot of confusion, because a buyer would, buy or sell is also used in the terms of buying or selling an underlying asset. So in order to avoid the confusion, for option buyer, I'll say holder, and for option seller, I'll say writer. So this definition is from the point of view of the holder of the option. So the holder of the option has the limited risk because he only pays the premium, and an underlying asset means it actually it's an underlying asset which actually makes it a derivative contract, because a derivative contract is something which does not have its own value. It derives its value from an underlying. That is why it is called a derivative product. An agreed upon price means the strike price. It's a price no matter whatever, wherever, the underlying asset at the end of the expiry, the price of the expiry, it does not matter. The prices are locked well before, at the time of the creation of the option only. And agreed upon date means the expiry date. So option contract is essentially a mechanism where the holder pays the premium to lock the prices of an underlying asset well in advance without having to worry about a future fluctuation in the prices of an underlying asset. A very real life example would be, for example, if you're making a plan to Goa, from New Delhi to Goa, you are taking out tickets, online tickets, air tickets, and the prices are quoting for on Make My Trip, say prices are quoting 5,000 rupees one way ticket of New Delhi to Goa. But you're not very sure about a plan that there is a chance that the plan may materialize or might not materialize. So the airline company is offering you a deal that pay 100 rupees and just lock the prices. No matter when you will purchase the ticket, we will just ask you 5,000 rupees. So you are basically locking the prices by paying a small fees to the airline companies. That is essentially, by all mechanism, it is an option. Another example would be insurance company. When you buy a car insurance, you are paying a premium against any potential damages that might occur in the future. So if the value of your car is say 5 lakh rupees, and you just pay a premium of 5,000 rupees, and if in future your car meets with some kind of an accident or damage, then your entire 5 lakh gets covered by the insurance company. So these are two real life use cases of an option. Now we will understand the classification of options. Options can be classified on the basis of the nature of transaction of the underlying asset. It can also be classified on the basis of treatment with the expiry date, and it can also be basis on the basis of the moneyness of the strike price. We will understand each one of it one by one. So, on the basis of the transaction of the underlying asset, options can be divided into two categories: call option and put option. Now, what is a call option? In a call option, the holder gets the right but not the obligation to buy an underlying asset at an agreed upon price and date. And in the put option, the holder has the right to sell an underlying asset at an agreed upon. This is the basic difference, the nature of the transaction. In the call option, the holder has the right to buy the underlying asset, and the put option, the holder has the right to sell an underlying asset. So remember that example, the previous two examples that we gave about airline and car insurance. So an airline example was essentially a call option where the holder was actually buying the right to buy the air ticket at an agreed upon price and date in the future. So that was kind of a call option. And an insurance is essentially a put option. A put option because you already have a car and you are insuring that car against the potential damages. Yeah, a potential decrease in that value of the asset. So that is why it is called a put option. And insurance is a put option. So these rights are purchased by paying a premium to the writer, and writer is essentially the option seller only. Now this is the payoff chart of a call option holder. Say I have just given a hypothetical example. Say if you are buying a 26,000, this 26,000 is the strike price. 26,000 CE is the and CE is call option, and 300 is the premium of the call option. So a holder of an option is locking the price of Nifty at 26,000. Maybe in the future, even if the Nifty goes till 27,000, 28,000, he will he will buy it at only 26,000. So this is the price that he has locked. This is the strike price, which is the lock price of the option. And for locking this price, he has paid a premium of 300 rupees. So the equation of for the holder of the option will be like this: if the value of Nifty at the expiry is below 26,000, it stays below 26,000. This is the 26,000 mark. Let me just point it out. Yeah, this is the 26,000 mark. If it stays below 26,000, then the loss of the option holder will be 300 rupees. 300 into 75 is the lot size, so it will be essentially 2,500 rupees. And if the value of underlying, which is Nifty, reaches 26,000, and if with after that, if every point, every increase in 1 point, the loss of the option holder will keep on decreasing by 1 point, because if Nifty expires 26,100, then this 100 will be deducted from this premium 300, and his loss will be 200. If Nifty will expire at 26,200, then these 200 will be deducted from the premium of 300, and his loss will be 100. So similarly, by this equation, he will have a break even at 26,300. That is the strike price plus the premium that he has paid to the writer. So after that, with every increase, if Nifty goes even beyond 26,300, with every increase in Nifty beyond 26,300, he will start gaining the profit. So for example, if Nifty expires at 26,500, then his total profit will be 500 minus the premium that he has already paid, which is 300. So his profit will be 200 rupees. So so in this chart, you can see that the profit potential for a holder is unlimited. It can, it can touch even the, the sky. Sky is the limit. But his loss potential is limited. It's limited to only the premium that he has paid. So this is the payoff matrix for a call holder. For a call writer, the payoff matrix will be entirely opposite to it. So if the Nifty expires below 26,300, then the 26,000, that is below this strike price, this entire premium will be come into the kitty for the writer. So he will gain the entire premium. So he will gain the entire 22,500, which is 75 into 300. Now if Nifty goes till 26,000 and it even starts gaining even more momentum, then with every increase in 1 point, he will start losing. An option writer will start losing 1 point from the premium that he has collected. So his break even will be at 26,300, and if the Nifty goes even beyond 26,300, then he will keep on losing and bleeding and bleeding and bleeding. So like in this graph, you can see that the risk for the option writer is huge. It is unlimited. So similarly, we can see the payoff chart for the put holder. For a put holder is, put holder is the option contract where the holder has the underlying asset and he is ready to sell at an agreed upon price. So he will only gain when the prices of the underlying start falling. So in this example, I have again selected the price. Lock price is 26,000 only. The strike price is 26,000. The premium is same, 300 rupees. But the nature of the transaction has been changed. It has been changed from call to put. So for a holder of the put option, the premium, he has paid a premium of 300 rupees. And if the market stays above 26,000, this is the 26,000 level. So he will lose the entire premium, entire 300 rupees that he has paid to the writer. He will lose that entire amount. And if the market starts trading below 26,000, then till 25,700, he will keep on losing amount, but that amount will be even, slightly lesser than he will losing here, because some of the losses he will be covering because of the movement of Nifty, which will be below 26,000, and his break even will be at 25,700. That is 26,000 minus the premium that he has paid to the writer. After 25,700, if the market moves 200 points, he will get the entire 200 points. The profit for the put holder will be calculated in this form. Next, इसका एकदम अपोजिट कर देंगे, तो we will see the payoff chart for the put writer. The put writer chart is entirely opposite to the put holder chart. Put holder, if somebody has written put, so he wants that the market should not fall. So if the market stays above 26,000, he will gain entire 300 rupees as premium. And if the market starts falling below 26,000, then with every increase in 1 point, he will start losing 1 point from his premium. And so his break even will be 300 points beyond the strike price, which is 25,700. So if the market goes even beyond 25,700, he will start losing even more and more. And you can see his risk is also, his risk is not capped. His profit is capped. He cannot earn more than the premium, but his loss is not capped. So these are the differences in the payoff charts of an option writer and an option holder. And as you can see, the option payoff charts are non-linear. In most of the other asset classes you come across, whether it is equity or say FD and all, the payoff charts are pretty much linear. In FD, the payoff chart is linear with respect to time. यानी कि एक साल का FD करोगे तो you will get say X amount. In 2 years FD you will get 2x amount, almost 2x. I am not taking into account the effect of compounding. And in equity, if you have purchased a Reliance stock and if Reliance moves 1%, you will gain 1%. If Reliance drops 1%, you will lose 1%. But in options, it does not happen in that way. The payoff chart is pretty much asymmetrical. I mean, if you have holded a call option and you are bullish about the market and the market moves in your direction, even if you can even in that scenario you can lose the money, and it can be vice versa. You have written call option, that means you are bearish and the market moves against you, even then you can make money. So this is the asymmetry in the options that will be explained later. Why does it happen? We will explain, we'll cover it in the later part of the session. So this is the table where which differentiate between the characteristics of the holder versus writer. The contractual commitment for a holder uh, is to write to this is for the call option. For a call holder, the contractual commitment is right to buy the underlying, and he does not have the underlying because he has purchased the right to buy the underlying. That obviously means that he does not have the underlying. And for the premium, he pays the premium, the writer receives the premium. Profit potential for holder is unlimited, and writer, as I explained in the payoff chart, it is limited. Loss potential is limited to the value of the premium, and loss potential for writer is unlimited. And a speculative view for a holder is he is basically bullish in the market, and writer's view is he is not bullish. Uh, and the position of underlying for writer is in the call option, the underlying is with the writer. And if we compare this table with the put option table, you can see in the contractual commitment, the put holder has the right to sell the underlying. Since he has the right to sell the underlying, that means he has the underlying. That is why he is trying to sell it. Remember the car insurance example I gave you. It was kind of a put option because you already have the car. That car was an underlying for you. So you were a put option holder there because you had the underlying. And in the case of possession of underlying for a put writer, he does not have the underlying. The premium is obviously paid by the holder only in both the cases, and premium is received by the writer. Profit potential again is limited to the. Here there is a slight difference. In the call option, holder has the unlimited profit potential. In the put option, the holder has a limited potential, that is premium adjusted to the value of the underlying. Think about it, because if you have bought a car, if you have purchased uh, a car insurance, then you cannot earn more than the value of the car. You can never gain. If the value of the car or IDV of the car is 5 lakh, you can never gain more than 5 lakh. So here there is a profit. There's a capping. I mean, technically it is a capping, but potentially you can still earn huge if you are a put holder. And profit potential is again limited to the value of the premium for the writer. Loss potential is limited to the value of the premium for holder, and loss potential is again Buyer's profit potential is holder's loss potential, because essentially it's a zero sum game. And the speculative view for holder is bearish, and the speculative view for writer is not bearish. Now, in the previous slides, we have covered on the basis of the nature of the transactions. We have classified options on the basis of nature of the transactions. Here, ये एक जस्ट इंफॉर्मेशन के लिए इसको एक कान से सुन लेगा, दूसरे से निकाल देने का. When we classify options on the basis of the treatment with the expiry date, we essentially get two types of options: American style, which can be exercised by the buyer at any time before expiry. It can be exercised even before expiry. And another is European style, which our market follow, because that's why we have CE and PE. CE means call European, PE means put European. It can be exercised only after the expiry. So this is the basic difference between now options can also be classified on the basis of the moneyness of the strike price. They can be classified into three categories: at the money, out of the money, and in the money. Now, to understand, to have a better understanding about it, let's first understand what the moneyness is. So moneyness is basically, to understand moneyness, we have to understand two important concepts about it. One is intrinsic value and the other is extrinsic value. Intrinsic value is essentially, for example, I'll just give you an example. If you go to a furniture shop and you go and you are asking the price of a table, a wooden table there, and the shopkeepers tell you that the price of the table is 10,000 rupees, and you ask him, okay, give me this table at 7,000. I'm willing to pay not more than 7,000 for this table. Then how the shopkeeper responds? He responds, भैया इसमें 8,000 का तो लकड़ी है, 7,000 में कैसे दे दे? So that 8,000 that he's saying is essentially the intrinsic value of that table. So in the option terms, the intrinsic value is defined. Suppose the market expires, अभी जहां पे है वहीं पे एक्सपायर कर जाए, जो अभी स्पॉट चल रहा है वहीं पे एक्सपायर कर जाए, then what will be the value of the option at that point of time is actually the intrinsic value. In the moment value of the option is basically the intrinsic value. For example, if Nifty is trading at 25,000 and say you have bought a 24,800 call option. Now if Nifty expires at 25,000 only, then the intrinsic value of 24,800 call option will be 200 rupees, because the option price at the time of expiry will be 25,000 minus 24,800, which is 200. Now the extrinsic value is whatever the total premium of an option is, उसमें से intrinsic value minus कर देने का, the remaining part is the extrinsic value. Extrinsic value of it. The extrinsic value actually represents different components like time, volatility, and expectations, future expectations in the prices of the underlying. ये एक फॉर्मूला है how to arrive at the intrinsic value. For the call option, the intrinsic value is spot price minus strike price if the value is positive. Otherwise, the intrinsic value will be zero. Like the Nifty example that I gave you, if the Nifty spot is at 25,000 and you have a 24,800 call, then the value of intrinsic value of that option will be 200, because 25,000 minus 24,800. And if the spot is at 25,000 and you have a call of 25,200, then 25,000 minus 25,200 is a negative number. So it will be zero. Intrinsic value will be zero in that option, in that strike price. So the hack is that if a spot is greater than a strike, then it has intrinsic value. If the spot is less than a strike, then it does not have any intrinsic value for call option. Strike the opposite. It's a put option. Strike price minus spot. Strike price यहाँ पे spot minus strike था, यहाँ पे strike minus spot है. If it is positive, then it has an intrinsic value, and otherwise it will be zero. And if the spot is less than a strike for a put option, then it has intrinsic value, otherwise it does not have intrinsic value. So this is basically the moneyness of the strike price. Now we will understand what the at the money OTM and at the money, out of the money, and ITM strikes are. So on the basis of the strike price, options are classified into three categories: at the money, OTM, and ITM. So any strike price which is closest with respect to the spot. Say Nifty is trading at 24,990. So its nearest strike will be 25,000. Okay, let me just give you another concept. In options, to make it a standardized product, the options strikes are depending upon the underlying, they are divided into a predefined strikes. Like in Nifty, we have strike at every 50 multiple. In the multiples of 50 we have. ऐसा नहीं होता कि you go to the your broker and बोला कि भैया मेरे को 24,980 की स्ट्राइक दे दो. ब्रोकर नहीं, वो बोलेगा नहीं, you can only buy or sell strikes which are in the multiples of 50 for Nifty. For Bank Nifty it is 100, for Sensex it's 100, and for stocks it depends upon the value of the stock. So in the Nifty case, when the Nifty spot is at 24,990, so its closest strike in the multiple of 50 will be 25,000. So 25,000 on both call and put side, it will be treated as an ATM, yani at the money. And out of the money, any strike for call option which is above the ATM are treated as out of the money. And for put options, all the strikes which are below ATM are treated as out of the money in the case of put options. For ITM इसका एकदम उल्टा. For call all all strikes below at the money are treated as ITM, and for put all strikes above ATM are treated as ITM. इंट्रिंसिक वैल्यू समझने का, तो एटीएम में जो इंट्रिंसिक वैल्यू जीरो होती है या फिर नेग्लिजिबल होती है, आउट ऑफ द मनी में भी इंट्रिंसिक वैल्यू जीरो होती है. जीरो क्यों होती है इसमें? क्योंकि बिकॉज फॉर ऑल स्ट्राइक्स इफ द निफ्टी इज ट्रेडिंग एट spot is 25,000, so all strikes above ATM will be OTM, so 25,100 will be an OTM. So इसमें since the spot is less than the strike, it will not have any intrinsic value. ITM में intrinsic value present होती है. Yes, that is why it is called an ITM. There will be some intrinsic value, and depending upon how deep we go into the strike, say Nifty is trading at 25,000, so 24,900 call में intrinsic value 100 rupees की होगी, 24,800 में 200 की होगी, और जितना भी नीचे और जाते जाएंगे, the more deeper we go into the strike, the more intrinsic value it will keep on incurring. And extrinsic value, ये concept है. Extrinsic value at the money में highest होती है, and OTM and ITM दोनों में it keeps on decreasing as we go on deeper into the strikes. And the reason why an extrinsic value is highest in ATM is, I'll just give you. I will share. Sorry. Let me share my. I'll explain it this on a simulator. Let me open my screen option is screen. Yes, hope that this screen is visible. So what I'll do, I'll just do an exercise. So this is 25,450 here. This will this has the since it does not have any. This is the ATM, so the extrinsic value will be 189. The entire premium will be here. So suppose we we buy uh, we buy this and 25,350 को हम सेल करते हैं और इसमें हम थोड़ा सा चेंज कर देते हैं हमारी थ्योरी को प्रूव करने के लिए 25,350 में 100 रुपीज की इंट्रिंसिक वैल्यू है बिकॉज ये 100 पॉइंट्स दूर है यहाँ से सो 143 इज द extrinsic value 243 minus 100 is 143 so our हमको ये चीज प्रूव करना है कि why the this is the higher I mean it is more in the ATM तो ये प्रूव करने के लिए हमको हाइपोथेसिस में उल्टा करना पड़ेगा we'll have to assume कि assume करो कि इसमें इससे भी ज्यादा होगी extrinsic value तो हम इसका प्रीमियम को चेंज कर देते हैं 100 तो उसकी इंट्रिंसिक वैल्यू है प्लस उसमें 189 से और भी ऐड कर रहे हैं 189 से ज्यादा होनी चाहिए उसकी वैल्यू तो 189 plus 100 is 289 so anything more than 289 so let's keep it 300 so if this happens you can see the payoff matrix in every situation in this trade will give you a profit which is essentially an arbitrage opportunity no matter market will go anywhere you will earn profit in this trade. So this is the reason this will not happen. The extrinsic value of any ITM cannot be more than the ATM. Similar चीज अगर हम इसमें भी कर सकते हैं सेम चीज अगर हम इसको निकाल दें एंड ऑप्शन चेन में अगर हम अब हमें ये प्रूव करना है कि OTM से ज्यादा वैल्यू ATM में होती है एक्सट्रिंसिक वैल्यू तो दोनों के केस में तो इंट्रिंसिक ना ओटी ना एटीएम में इंट्रिंसिक वैल्यू है ना इसमें है ठीक है तो इसको हम सेल करते हैं एंड हम एज यू हमें अपना हाइपोथेसिस को प्रूव करने के लिए हमें इसका वैल्यू 189 से ज्यादा रखना पड़ेगा तभी इसका एक्सट्रिंसिक वैल्यू इज मोर देन 189 होगा सो लेट्स कीप एनी नंबर एडिटेड so let's keep it anything more than 189 say 200 say in this situation also in every no matter where the nifty goes इस पोजीशन में somebody would be earning sure short profit. So this is the reason this will never happen. The extrinsic value of an ATM strike is always the highest, always the highest. Hope it makes sense. Now let me share my screen PPT again. Or this is an exercise that you can do meanwhile, and we will discuss it in Q&A. if Nifty spot is at 25,910, what is the intrinsic value of 25,000 CE? What is the intrinsic value of 25,000 PE? What is the intrinsic value of 26,000 CE? And what is the intrinsic value of 26,000 PE? You can just calculate it, and we will discuss it in Q&A session. Now,
Hey, Anurag.
okay.
Hello.
Yeah.
Anurag, I was just thinking because we are already at 12:40. So maybe Greeks, I don't know, like how much time should we take it up in the next session and now use the time for any question and answers till now?
Sure, we can do that. Yeah.
Yeah.
और ग्रीक्स में अभी 5 मिनट में अगर कवर कर सकते हो तो वी कैन कवर, देन वी कैन टेक इट अप. Either way.
Yeah. Let's see if I mean if there are any questions, maybe we take the
Okay, let's take
questions.
the
If not,
first one.
then maybe yeah, then you continue.
Sure.
Anurag, basically Greeks are too much for a fresher to absorb, I suppose. So we can just give them a high level names and the meaning maybe.
Sure. So Greeks are basically all those factors which affect the price of the option. So there are essentially 5 types of Greeks. First one is the delta. Delta is nothing but the what is the probability of an option expiring in the money. Because remember, only the in the money option has the intrinsic value. So if the option expires in the money, then only it will have at the expiry, it will have some value, otherwise it will be worthless. So delta tells you what is the probability that an option will expire in the money. And it also denotes कि अगर underlying में suppose करो say any strike price has a 40% probability, 0.4 का delta है, then it also means that if the underlying moves by 10 points, then the option will move by 10 into 0.4, yani 4 points. For CE option, the value is denoted in positive. For PE option, the value is denoted in negative. It's for the notation purpose only. And if we talk about, if we classify with respect to the moneyness, then ATM options, the Greek, the probability to expire will always be 0.5. I mean, very near to the 0.5, because it's either way. अगर 25,000 पे निफ्टी चल रहा है and 25,000 का स्ट्राइक है, then वो उसका 25,000 के ऊपर भी एक्सपायर होने का उतना ही प्रोबेबिलिटी है जितना उसका 25,000 के नीचे एक्सपायर होने का प्रोबेबिलिटी है. सिमिलरली आईटीएम में जितना हम डीप जाते जाएंगे उतना उसका डेल्टा बढ़ता जाएगा, बिकॉज अगर द मोर डीपर वी गो द प्रोबेबिलिटी ऑफ एक्सपायरिंग दैट ऑप्शन इन द मनी विल बी इवन बेटर. ओटीएम में उल्टा होता है, 0. जितना हम नीचे जाते जाएंगे, ओटीएम जाते जाएंगे, उतना प्रोबेबिलिटी उसका कम होता जाएगा. Now the gamma denotes how fast the delta is changing when the underlying prices moves. So the gamma का जो effect होता है, it is more impactful when the option is very near to its expiry. When the option में expiry में time होता है, then it does not play much role. Gamma basically denote करता है कि सपोज करो कोई ऑप्शन से एटीएम था, एटीएम के टाइम पे उसका 0.5 का डेल्टा था, एंड if the moves comes in the favor of the option holder, वो जैसे जैसे ऑप्शंस का प्राइस ऊपर तक जाता जाएगा कॉल ऑप्शन का, वैसे वैसे आपके स्ट्राइक का डेल्टा भी चेंज होता जाएगा. 0.5 से 0.6 हो जाएगा, एक टाइम पे 0.7 हो जाएगा, बिकॉज नाउ एज द प्राइस मूव्स इन योर डायरेक्शन द इट इज आपकी प्रोबेबिलिटी बढ़ रही है टू एक्सपायर इन द मनी. सो ये जो डेल्टा को बढ़ा रहा है वो काम गामा करता है. गामा इज बेसिकली एक्सेलरेटर. So when we compare it from the moneyness wise, at ATM the gamma is highest, at ITM gamma is low, and OTM is also low, and the gamma plays actual role near the expiry. When the expiry is very near, एंड इसलिए आप एक्सपायरी के टाइम पे यू विल हैव कम अक्रॉस अ लॉट ऑफ स्टोरीज जिसमें 1 रुपए का ऑप्शन 50 रुपए हो जाता है, 100 रुपए हो जाता है, एंड दैट इज व्हेन बिकॉज उसमें गामा का इफेक्ट आ जाता है। इसकी एनालॉजी को समझने के लिए एक एग्जांपल है क्रिकेट का। दिस इज दिस इज द स्नैपशॉट फ्रॉम अ वेरी फेमस मैच फ्रॉम वर्ल्ड कप T20. India needed 28 runs of 8 balls at that point of time, and most of the broadcasters were giving India a 3% probability to win the match, and they were giving almost 97% probability for Pakistan to win the match because the match was very towards its end, and it was highly probable that India gonna lose the match because 28 runs hard ball में बनना against a very good pace attack is not that easy. बट उसके बाद नेक्स्ट 2 बॉल्स पे हैरी स्टॉफ को विराट कोहली ने ही स्कोर्ड बैक टू बैक सिक्सेस ऑफ दोस 2 बॉल्स। नाउ उसकी वजह से probability of India winning significantly improved from 3%. It shot up, and at the end India actually won the match, so it was technically 100%. तो ये जो 3% का probability 100% हो गया इंडिया का, वो उस गामा की वजह से हुआ। वो जो 2 सिक्सेस विराट कोहली ने मारे, दोज वर एक्चुअली गामा, एंड दोज केम at the end of the match, towards the end of the match, that was technically an expiry, towards expiry है। so that was इंडिया का जो probability 3% से 100% हो गया, that was 33 times jump in India's winning probability। so वो जो effect आया वो it was because of gamma। सिमिलरली निफ्टी के केस में क्या होता है, या ऑप्शंस के केस में क्या होता है, से द एक्सपायरी अभी 5 मिनट में होने वाली है एंड 25,000 एटीएम चल रहा है। 25,000, तो उस समय जो 25,050 का स्ट्राइक होगा उसका डेल्टा चल रहा होगा लगभग 5% के आसपास, बिकॉज अभी सिर्फ 5 मिनट में 50 पॉइंट का मूव आना बहुत ही हाईली इम्प्रोबेबल है। बट एज्यूम करो 5 मिनट में 100 पॉइंट का मूव आ जाएगा, तो 25,050 का जो स्ट्राइक जिसका प्रोबेबिलिटी बहुत ही कम था, 5% था, अब उसका इन द मनी एक्सपायर होने का प्रोबेबिलिटी इट हैज बिकम 100%। सो विद इन 5 मिनट 100 पॉइंट्स मूव टुवर्ड्स द एक्सपायरी, it can give you a potential of the option prices technically exploding. It can go up from 1 rupee to 50 rupees. So this is where gamma plays an important role. Another Greek is Vega. Vega is essentially the volatility. If the if there is uncertainty in the market, there is a lot of things going on, war and all, and Trump's tweet and whatnot, then the market will be considered to be more volatile. So therefore, because since it is, the more uncertainty will be there, the prices of the premium will be more. On the other hand, there are phases when everything is going very smooth as per there is nothing, no event lined up. In that scenario, there is not much uncertainty in the market, so volatility is also very low. So in those scenarios, the option premiums are very cheap. So in terms of moneyness, ATM options are Vega is highest. When there is slight ITM on OTM, the Vega is medium. And when the expiry is very near, the effect of Vega is very minimum, because when the expiry is very near, then there is hardly any uncertainty left. But when there is 1 month left for the expiry or 2 months left for the expiry, then a lot of things can happen over next 2 months or 1 month. So there is more uncertainty. That is why the Vega in those conditions will be very high. This is the friend of the option writer, theta. Theta is basically अगर स्पॉट और आई वोलेटिलिटी बिल्कुल भी मूव नहीं किए एक दिन, और लेकिन एक्सपायरी में एक दिन कम हो गया, तो व्हाट विल बी द इफेक्ट ऑन द प्राइसेस एसेंशियली मेजर्ड बाय थीटा, and theta is always negative for a holder of an option, that is a buyer of an option. For option seller or option writer, it is always positive, because they always gain from this theta thing. Again, theta is also when it is highest in the ATM options, and when the options are very near to its expiry, theta decay is observed more rather than when they are very far from the expiry. This is just for general knowledge purpose. It does not play much role in the pricing of the option, because it only changes when there is an interest rate changes, which hardly gets changed. Uh, I mean, in a year there are only 2 or 3 times when the interest rate gets changed. And for the call options, when the interest rate changes by 1%, the call premiums increase slightly. And for put option, when the interest rate goes up by 1%, then interest rate goes down. Sorry, premiums goes down. The reason being, in the call option, the underlying is with the writer. So the writer will demand more premium when the interest rate changes. He will demand more premium because his cost of capital will increase. And in the put option, the underlying is with the put holder, or the holder of the option has the put has the underlying. So when the interest rate changes by 1%, the put holder will demand more. I mean, he will want options at a cheaper price to adjust his cost of capital. That is why. But this Greek is hardly significant for, I mean, daily use. So this was all. Now we are open up for Q&A round. Any questions? You can just ask. Hello.
If if anyone has any question, can unmute themselves and can ask. Mr. AV, you were asking about the overall structure, plan, expected outcome, and how much in depth we'll be going with the algos. We
Yes.
had taken an Q&A session previously. Before we started, we had taken an introduction session previously before starting this last week. I am not sure if you're there into that session. In that session,
No,
we
I
have
was not
also
there
taken the
actually.
Okay, so you should have joined that session. You could have added the feedback or what your expectations from the sessions what we'll be conducting. Okay, in these sessions we are purely planning to give you something in samples, like 6 to 8 non-coding strategies, and 2 or 3 Python-based strategies. Those strategies will be purely sample strategies to make you understand how a strategy has been done. See, I have replied you in the best way I can. In the case you want to know anything furthermore, we can surely help you further on. Like you can even DM me. Okay.
Sure.
And can I know your good name, please?
My name is
Can I name
Ashish
you complete? Ashish, what?
Dinkar.
You what's your mobile number? Like I cannot spot you into the WhatsApp channel.
Uh, I'll just DM my mobile number to you.
Okay, great. Sure. Anyone else? Anyone else? Any other question?
Hey, Anurag, one question. So, can you explain am I audible?
Yeah, you're very much audible. Tell me.
Okay. So, one question on this. So, what's the relationship, or is there any relationship between the call and the put options pricing, or rather the price at which the call or the put option is getting sold for the same strike and throughout the entire day? So, is there any kind of relationship there? So, let's say, for example, let's say the market is trading as 30,000, and the call option is we buy a call option of let's say 25,000, um, and a put option of around same difference, like 500, so 35,000. Right. So, would there be a difference in the price of this, or it really depends on the market situation?
See,
Anurag will
normally,
reply to you.
normally when you compare when you compare with respect to the spot, it is normally seen that the options of the call will be more. Price of the call option at ATM will be more than the price of the put option. The reason is because the prices that market calculates is not on the basis of the spot; it is on the basis of futures. And futures is normally always trading at a premium. So there's always a, if you see a Nifty spot and say if you see a premium future of Nifty, there will be a difference of like depends upon how many days are left for the expiry. So the options of prices of the call option will always be more than the put option. And if you want a comparable prices, then one should look at the synthetic future, which is another concept that will be covered in the next session. But
Okay. And this is
The
for the
implied
ATM, right?
future or the synthetic future, implied future and the synthetic future is a advanced topic. Okay, and we will try to cover that. We will try to give a touch up into the next session, but you have to first understand the options and its behavior before we get into the implied or synthetic future.
Got it.
Okay. So, any more questions? So in the next session, see, session 2 is equally important. In the session 2, we will be giving you a hindsight of why you need a mentor, because algo platforms and algo strategies, once we have them, why we need mentor is the question every individual or every newbie has got into this market. Okay. So we will be giving you a like hindsight why you need a mentor whenever you are starting your algo journey. Because in that session you will come to know we will be covering the psychology, the money management, and the most important, the discipline. Okay, so do please attend the next section. And also like most I have of you have like opened the account, but few of you are still like not completed their account opening process with the referral links. So I will request you everyone to finish their account opening process before this weekend, or at least initiate them before this weekend. So that will help us to continue everyone to the next batch. Okay. So Anchal, Anuragji, should we call it like a end of the mid, or you want to
sure.
cover anything
At
more?
the just one thing I just wanted to add. If you have any query meanwhile during the week as well, you can just post it in the group itself, and we'll try to respond as early as possible. And we will also try to post an assignment in the group, and we hope that everybody completes that assignment by the end of the session, by the beginning of the next session.
Maybe you can just show that right now, Anurag. You had like, on the next slide, you have the assignment, right?
Sure. Okay. Yeah, I can show there only. This is the assignment for the next session. Now, you have to pick a Nifty option chain and calculate the intrinsic and extrinsic value of any ATM, OTM, and ITM option of both the sides, call and put. And for calculating the intrinsic and extrinsic value, you can consider the spot value of Nifty index, and expiry date that can be considered should be either 18th of November or 25th of November, your choice. Either 18th November, which is a weekly expiry, or 25th November, which is the monthly expiry. And the part two of this assignment is from the Nifty option chain. Note down the delta and implied volatility. If you go to any, your broker also gives, and Algo Test also gives the option chain. They also have this delta and implied volatility mentioned in the option chain itself. You go to that option chain and note down what is the delta and implied volatility of ATM, OTM, and ITM options of both sides, and expiry to be considered is 18th November and 25th November. If you have any doubts regarding this, you can ask here only, and also if you have any doubt, you can also ask in the group. So if there's not any further questions, then we can just call it a day. Thanks for ending the session.
Thank you,
So
Anurag.
everyone have a great weekend.
Thank you, everyone.
Thank you.
Yeah, thanks a lot.
Bye bye.
Bye.